Hey everyone, welcome back to Corporate Decoder, the place where we unpack the confusing world of corporate finance, and today we are diving deep into InnovAge Holding Corp's latest quarterly report, and let me tell you there are some significant shifts happening under the hood. This report covers the period up to the 31st of December 2025, and it gives us a clear look at how the company is navigating a complex healthcare landscape. We'll break down the key financial numbers, look at where they're spending their money, and see what the future might hold. Before we get into the nitty-gritty, if you find value in these deep dives, make sure to hit that subscribe button, and if you want to chat about these filings with other finance enthusiasts, join our Discord community linked in the description below. Let's kick things off by looking at the company's financial health as of the 31st of December 2025. InnovAge reported total assets of about $527.5 million, a slight increase from around $526.9 million at the end of June 2025. This stability in assets is interesting, but let's see what is driving it. Their current assets, meaning things that can be turned into cash within a year, stand at just over $181 million. That is up from about $176 million. The biggest chunk here is cash and cash equivalents, which jumped from $64.1 million to $83.2 million. That is a nice boost in readily available cash, which is always a good sign. On the flip side, their current liabilities, or what they owe within a year, are sitting at around $144.7 million, down from about $164.8 million. This reduction in short-term debt is positive, showing they are managing their immediate obligations well. Looking at their total liabilities, they've come down from about $263.9 million to $238.7 million. This is a significant drop and indicates they are actively paying down their debts. And when we look at stockholders' equity, which is essentially the owner's stake in the company, it has grown from about $237.9 million to $261.2 million. This growth in equity, combined with a reduction in liabilities, paints a picture of a company strengthening its financial foundation. Now let's move to the income statement, which shows us how profitable the company has been. For the 3 months ending the 31st of December 2025, InnovAge reported total revenues of nearly $240 million. That is a good increase of about $30.7 million, or almost 15% compared to the same period in the previous year. The bulk of this revenue, about $239.6 million, comes from what they call capitation revenue. This is basically a fixed amount paid per Pascal participant per month, regardless of how much care they actually need. This predictable revenue stream is key for businesses like InnovAge, which manage care for seniors. They also have other service revenue, which is much smaller and actually decreased quite a bit. For the 3 months, it fell from $325,000 to just $88,000. This shows that their core business is indeed in that predictable capitation revenue. On the expense side, total expenses for the quarter were about $226.4 million, a modest increase from about $221.6 million in the prior year. And here is where it gets really interesting. The company swung from an operating loss of over $12.5 million in the last year's quarter to an operating income of over $13.2 million this year. That's a massive turnaround, showing they are becoming much more efficient. This positive trend continues down to the bottom line. Net income attributable to InnovAge Holding Corp was over $10.6 million for this quarter, a huge jump from a net loss of over $13.2 million in the same period last year. This really highlights the improved performance. Looking at the 6-month period ending the 31st of December 2025, the picture is similarly strong. Total revenues increased by almost 15% to $475.8 million. And importantly, their operating income more than doubled from a loss of $17.4 million to an income of $21.5 million. This consistent improvement across both the quarter and the half year is compelling. Now let's dig into those expenses. The cost of care, which excludes depreciation and amortization, increased by a significant 16.9% for the quarter and 18.3% for the 6-month period. While revenue also grew, this expense growing faster than revenue warrants a closer look. They mention this is due to higher salaries, wages and benefits, as well as costs related to an in-house pharmacy transition and fleet costs. This is a key area to watch. Sales and marketing expenses saw a smaller increase of about 4.9% for the quarter and 10.5% for the 6 months. This makes sense as they are trying to grow and reach more participants. Corporate, general, and administrative expenses actually decreased slightly for the quarter by 5.3%, mainly due to lower legal and consulting fees. However, for the 6-month period, they increased by 2.2%, driven by employee compensation, contract services, and software fees. It seems like they are managing some corporate overhead well, but other areas are ticking up. This line item is particularly interesting. For the 3 months ended the 31st of December 2024, they had an impairment and loss on assets held for sale of over $8.4 million. This dropped to zero for the same period in 2025 and only had a small $104,000 charge for the 6 months. This suggests they are moving past some of the issues that led to asset impairments previously. Now, let's talk about adjusted EBITDA, a non-GAAP measure that management uses to assess performance. For the 6 months ending the 31st of December 2025, adjusted EBITDA came in at almost $40 million, a massive jump from about $12.3 million in the prior year. This indicates strong underlying operational performance when you strip out certain items. The adjusted EBITDA margin also jumped significantly from 3.0% to 8.4%. This shows that for every dollar of revenue, they are keeping much more as operating profit after these adjustments. The report explains this improvement is due to increased census, better capitation rates, and lower per participant external provider costs, despite higher center level headcount and wage rates. Let's also touch on center level contribution margin, another key performance indicator for InnovAge. For the 6 months, this measure rose to over $104 million, up from about $71.6 million. As a percentage of revenue, it improved from 17.3% to 21.9%. This is a fantastic improvement, showing that their individual centers are becoming more efficient and profitable. The company served about 8,010 participants, resulting in a total of over 47.4 million member months for the 6 months ending the 31st of December 2025. This is up from about 43.5 million member months in the same period last year, indicating solid growth in their participant base. While the GAAP net income margin improved dramatically from negative 4.6% to positive 4.1%, the adjusted EBITDA margin of 8.4% suggests there is still significant room for improvement once all reported items are considered. Looking at what drives their business, InnovAge highlights several key factors. One is their focus on frail, high-cost dual-eligible seniors. These are participants who qualify for both Medicare and Medicaid, and they come with higher capitation payments because they generally require more complex care. Their average risk adjustment factor, or AF score, is very high at 2.5. Confirming they are indeed managing a medically fragile population. This strategy allows them to potentially earn more from these participants than from simpler cases. They are also focused on growing enrollment and capacity. This involves opening new centers and also maximizing the number of participants in existing ones. Regulatory hurdles, competition, and sanctions can impact this growth, which they acknowledge. Speaking of regulatory hurdles, the report mentions a significant challenge, a California moratorium on PACE applications, effective November 2025, pausing new applications for at least 2 years. This will definitely impact their expansion plans in California, at least temporarily. The company also deals with a lot of legal matters. There is a significant mention of litigation costs and settlements totaling over $2.2 million for the 6 months. This includes a class action lawsuit related to their IPO that was settled for $27 million. They also have ongoing civil investigative demands from government agencies, while they seem to be managing these costs. It is a substantial drain on resources and a constant risk. Their income tax provision for the 3 months ended the 31st of December 2025 was $651,000, resulting in an effective tax rate of about 5.2%. This is a significant improvement from the negative tax rate in the prior year, reflecting their return to profitability. However, the report also details a substantial valuation allowance against deferred tax assets, meaning they don't believe it is likely they will realize certain tax benefits, especially from state net operating losses. Beyond the numbers, there are also many risks and uncertainties outlined. They mention labor shortages, macroeconomic challenges like inflation, and the potential for government program changes. The impact of the One Big Beautiful Bill Act, which mandates Medicaid spending reductions, is also a significant concern for their revenue streams and operational adjustments. Overall, InnovAge is showing a strong rebound, particularly in terms of profitability and operational efficiency, as evidenced by the significant increase in operating income and adjusted EBITDA. Their strategy of focusing on high acuity, dual-eligible seniors appears to be paying off in terms of higher revenue. Per Pascal participant, the reduction in liabilities and growth in equity are very positive signs of financial strengthening. However, there are clear challenges. The rising cost of care, especially labor costs, is a persistent concern. The California moratorium on new PACE applications presents a significant hurdle for their expansion plans in a key market. The ongoing legal battles and investigations, while seemingly being managed, are a constant drain and potential unpredictability. The effectiveness of their clinical and operational value initiatives will be crucial in managing these costs. Looking at the numbers, the shift from a net loss to a net income is undeniable, and the growth in their participant base and revenue is robust. The improved center. Level contribution margin is a particularly strong indicator of operational improvement at the ground level. The company's direction seems to be focused on leveraging its specialized care model for complex seniors, while carefully managing costs and expanding its reach. The growth in member months suggests they are successfully attracting and retaining participants. The main weaknesses lie in their susceptibility to regulatory changes, the increasing cost of care, and the ongoing legal and compliance burdens. Opportunities exist in further optimizing their existing centers, successful de novo center development in other states, and potentially through strategic partnerships or acquisitions. In conclusion, InnovAge is on a positive trajectory, demonstrating a strong turnaround in profitability. The company is successfully managing its core operations and growing its participant base. However, investors should remain mindful of the inherent risks in the healthcare sector, particularly regulatory changes and rising operational costs. Alright, that is our breakdown of InnovAge's latest filing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.